Hey everybody, thanks so much for joining us. We're getting started right at noon, and as always, we'll be going over who Catalyst is just at the beginning. We are really excited since this is our first market update of the year, and we hope you are too. If you have joined us on previous webinars, thank you so much for coming back. And if you're new, we're excited to tell you a little bit about who we are. So this month, we're going to be going over December numbers. We'll also be going over some national news and all the major metros in Texas. Before we get started, we do want to go over that this is for general information only, that we're not liable for any investment opportunity that you partake in after watching our webinar. We are trusted advisors though, so if you want to get with one of our loan officers at the end, feel free to give us a call or shoot us an email. We will have our contact information up at the end of the presentation. Jeff, did you want to go ahead, or Wade, whoever wanted to take this slide?
I want to do it, please.
Okay.
Hello, everybody. Thanks for joining us. Just a brief background on who Catalyst is and what we do before we roll into the report for the month. So if you do not know who we are a one-stop shop lending company for all real estate investors primarily. We offer hard money loans for people that want to flip, or if you want to do buy and holds. And then we also offer permanent financing. So we roll in the hard money loan into our refinance. We can do both sides of the transaction. And with rates being as low as they are right now, a lot of our investors are taking advantage and doing straight rate and terms on some of their investments or their primaries, or pulling cash out. A lot of their, as you'll find out in the article or the webinar later, prices are up. So a lot of folks have equity. So a lot of people are using that equity to pull cash out to buy more deals. We are a lender built by real estate investors. We offer, we've been doing investing since before we were doing lending. We have a great team that offers off-market opportunities to some of our borrowers as well. So if you're interested in that, give us a shout. We've done thousands of transactions over the years. We have one single point of contact loan officer for all of your loans. So your same LO that does your hard money will do your conventional as well. All of our loan officers are fully licensed. And you can usually get approved for all of our products with one credit pull. And if you have a deal that you want to go see fast and you're in a hurry, reach out to us, and we can typically get you a pre-approval letter as quickly as 24 to 48 hours, so you can go buy that house. Next slide, please. There we go.
Hello, everybody. I'm Wade. Happy New Year to you. We provide a wide variety of products, as Jeff has mentioned. We provide hard money loans, which are loans to purchase and repair distressed real estate. We provide conventional refinance loans for landlords. Those offer the best pricing and terms. We also offer non-conventional refinance programs for buy and hold investors, so that even if you do not have that credit, you can still own rental properties. We offer primary purchase, refinance, and cash out. There are a tremendous amount of people right now that are fueling their real estate investments with a refinance to get cash out of their primary or non-owner occupied properties. We've seen people take that, maybe they have $100,000 in equity in their home and they take that to buy for rentals or start their flipping business as well. We have non-conventional options as low as 500 FICOs. For people who may not have perfect credit but still want to hold those properties. Our hard money interest rates start as low as 6.99% and 2 points. We have a really cool VIP flip program with much lower interest rates, options as low as 1 point, and even the ability to go well above the normal interest rates provided to flippers out there. And while we don't go into all of them here, we do have several products that I am not aware of any other competitors in the state of Texas having for buy and hold and other types of investors. So I think it's definitely worth calling one of our people and having a chat about how we can help you out.
Awesome, thanks, Wade. And you guys just heard him speak, but here are our speakers today. This is Wade Como. He's our founder and president. Wade started his career in 1995 in lending and management. He has worked for very large companies and led sales teams and operations team of up to 1,400 employees at a time. He's a licensed mortgage loan originator, real estate agent, and active investor himself. Jeff Johnson is our director of lending. Jeff manages all of our lending operations within Catalyst. He has over 20 years of experience with some of the larger national companies as well. And without these two, we wouldn't have Catalyst, and we certainly wouldn't have the webinar today. So thank you guys so much for being on and providing all this awesome information for everyone. Without further ado, we'll go ahead and get started with January's 2021 market update.
Okay, so let's go with, we covered this on the last meeting. This is the Fannie Mae Home Purchase Sentiment Index. It takes into account a limited number of questions. They are asking the general population. I don't believe they make any kind of discrimination as to like homeowners or the qualification of the respondents, but I believe it's just the general population asking very specific questions about, is it a good time to buy real estate? Is it a bad time to buy real estate? The sentiment dropped for the second month in a row. If you look at the chart, it started out, it was in the, I guess the good time to buy, good time to sell was at its peak in February, and then coronavirus had hit, it plummeted. When it started rising back up considerably, it's gone down a little bit. I think, I don't know how much how relevant this really is for investors. A lot of it has to do with just the general population. Some of the things they take into consideration are like your income and likelihood of prosperous a year, basically. Like, how do you feel like your finances are going to go in the next year? So, with the general population, I'm sure a lot of folks are scared, right? Because they've been unemployed or they're sort of fearful about coronavirus. But as far as real estate investors go, it does not really seem to have any effect on what we do.
We're going to cover a lot of data that shows people are very confident that are in the real estate space. I do agree that because of a wide variety of things, there may be a little bit more concern from people in general about their overall future based on some things that happened in the last month or so. But I think overall, we're going to see that did not impact real estate statistics very much at all, other than the normal seasonality that happens in the winter months almost every year. Next slide, please. All right, so this is a very interesting article that we found talking about 2 critical threats to housing affordability. So that is not, whenever you see critical threat, people may get a little bit nervous, but this is not a threat to home prices or appreciation. It's a threat to affordability. So very interesting things here. It talks about how the demand side remains very robust and inventories are lean. This is something that's been an ongoing trend. A lot of demand for homes, very few homes are available. Price growth and rising construction costs continue to threaten housing affordability going into this year. You can see the chart here, the average prices and projected prices like futures for lumber really just skyrocketing since November. Those statistics are pretty shocking. There's actually a number down at the bottom that have gone up 60% since mid-November. It's because there's such an interest in expanding the number of homes that are being built, that prices are being propped up. So this is really good for investors like most of our customers that are buying existing properties or owning existing properties and seeing appreciation there. Because if people cannot buy new homes, they have to go to existing homes, and then those prices continue to ratchet up. Single family construction in traditional second home communities was up significantly. This is another thing that we've seen while the coronavirus has had, very sadly, a larger impact on people who are not traditional home buyers. Most people in that category that are home buyers or investors, the stock market has done well, and many of those people in white collar jobs have been able to maintain employment. So there's a lot more second home construction and second home purchases at this time as well. Another very interesting stat, you can see the recent slowdowns illustrate challenges for the housing industry in 2021. Home price growth has been strong, up 8.4% year over year in October. We're going to show some other numbers nationally that those numbers were even greater in November, but overall prices up and new home construction costs are up significantly at this time. Next slide.
So this is data from Realtor Magazine, and it kind of tells the same story that we were just talking about. So home buyers, there's just less inventory to choose from. The number of homes for sale sank to an all-time low in December nationally, below 700,000 for the first time ever. Home buyer demand is high, and what you're seeing is bidding wars, right? If you're somebody trying to buy a house, you're experiencing this for sure. anecdotally, family friend put their house on the market, decent house in an older neighborhood, and they had 3 offers within a day, 1 over ask, right? So it's very competitive right now because there are just not as many places for sale. Home prices are up double-digit numbers compared to a year ago across the board. The number of listings has dropped nearly 40% from last year. Right? That's almost $450,000 fewer homes for sale in December compared to December of 19. Overall, list prices continued to increase in December. The median list price was up 13% year over year in that month to $340. However, that is a slight decrease from its previous peak of $350 earlier in the year. So you're seeing massive increases. A couple of things that I saw that weren't on this slide, but December nationally for the year, December was the 5th best month for the year. And that's very telling because usually December is one of the worst months. People just aren't buying houses in December. Yet December this year was 5th out of those 12 months. Year over year, the number of units sold in December nationally was up 20%, which is crazy, right? 20% more transactions in December of 2020 than there was in 2019. And then one more stat that I found from the same realtor website. December 2020 had a record inventory low of 1.8 months of inventory. So less than 2 months of inventory for December 20. That is half of what it was in December of 2019. So it's just kind of reiterating the story we've been telling for the past couple of months is that inventories are shrinking. There are just not that many houses for sale. Next slide.
This is a very interesting slide. This information came out very recently, last couple of days, but it explains a lot about why the housing market is so tight. So you can see the chart on the right, and it shows back in 2005. I don't know exactly what that number is. I'm assuming it's about 7.5% of people lived in their home more than 20 years. Now that number, in just 15 years, it jumped to nearly 25%. That is a shocking number whenever you think about it. And it just means people are not moving as much, so there are fewer existing home opportunities, and prices continue to ratchet up. A couple other interesting stats here. In 2020, typical homeowner remained in place for 13 years, up slightly from 12.8 in 2019. But the big jump is from 2010, which was 8.7. So in just that 10-year period, that's about a 66% increase in the number of people staying and how long people are staying in their homes. That's a really big jump across. So a lot of different factors. The article suggested that some people have been reluctant to act for some reasons, maybe concerned about finding a new home, or that the market's really competitive. Baby boomers are staying in their homes later in life. And then I think another thing is just a lot of states have very restrictive new construction policies. Like they don't allow a lot of new construction. They are very limiting on permits and different things of that sort. We happen to live in a state in Texas where that is not as restricted, and I think prices are able to stay more reasonable because of that. But I think that is a factor here as well. But whenever you think about that big of a jump in such a short time frame, it's really shocking to me and really explains why prices are jumping up as much as they are.
Yep. Plus, one thing that I also read that kind of contributes to that is mortgage rates being so low, like they are. People are more likely just to refinance and stay in their home and lower their payment, right? If they want a lower payment, they want to stick around. Maybe their income is less. They can just refinance.
Yep. Next slide.
So this was an interesting chart that I thought we would throw in there. Metros with the largest increase in new listings. So this is basically the one thing this tells me more than anything is where are people leaving, right? If you're in a city that's got more listings this year than you had last year, leads me to believe there's more activity, more people are moving. And it's broken down by market, and it seems to line up with the narrative we've seen read over the past 6 months or a year, where people are leaving high-priced areas like California. Right? Look at the top 5. They have 3 of the top 5. You know, in Washington D.C. and Boston, they aren't exactly cheap either. So people are leaving the more expensive places to live, and they're coming to cheaper homes. Right? It's just easier to buy a house in certain areas. And if you scroll down to the next slide, at the bottom, that's where you're going to see people moving to, right? Less listings, people are going to stay there, right? So you see Texas, you see San Antonio, you see Dallas, you see Austin, right there, all in that -10, -11% range. I don't see Houston on here. Oh, there it is. Thank you. -3. So it just kind of is more statistical evidence that people are leaving the higher priced places to a little more affordable living for a bunch of reasons. One of which is because of the pandemic. A lot of people are just able to work from home. They don't need to be in places that are so expensive. They can live like a king in a much cheaper area and work remotely, instead of living in San Francisco and, paying $1 million for 1,000 square feet.
Yep. Next slide. This is just some other information about how many people are moving and taking advantage of the opportunity here in Texas, which is just great. Real estate overall. So some really impressive statistics, but Tennessee did claim the top spot this year. And this is tracking one-way U-Haul deliveries. So think through that. Why would anyone do that unless they are going from somewhere to move, right? It wouldn't make sense to really do that. So they think, a lot of people think this is a very good indication of population shifts throughout the country. And Texas has been in the top 2 states with the most arrivals since 2015. So that's over that entire time frame. But also for the 5th straight year, Texas has been in the top 2. So it's not just that one year was a big jump. This is a very consistent trend of people moving to a state with more reasonable prices and whatever other reasons they may be moving here. But it is very consistently happening across the board. Texas had the largest net gain of one-year U-Haul trucks for 3 consecutive years, and then Florida flipped that number last year. And in California, Illinois, and New Jersey had the states with the least amount of one-way arrivals. So a lot of people moving out of those higher-priced areas with more restrictive policies on new construction and things of that sort. So what's that?
If you look at the map, they're all, I guess, not excluding Ohio, they're all southern states.
Yep. You want to be warm as well, I guess.
I don't know.
I kind of like that, avoiding all that snow. All right. So now we dive into the different cities, and
So this is Houston. A lot of data to swallow here. Houston had a great year. So I'm just going to read through these. Despite a devastating global pandemic, 2020 was a record year for Houston real estate. 96,000 single-family homes sold versus roughly 87,000 in 2019, the last record. So last year was a record, and we shattered the record this year by over 10%. We just kind of sink that in for a while. Last year was the best year ever, and this year was better by 10%.
And another thing there, Jeff, is that record was broken with, I think, April and May being incredibly low at the beginning of the pandemic. People didn't really know what was going to happen. Those 2 months were very, very low. Then after that, it was just through the rest of the year, just crushing. The numbers just jumped through the roof.
Yeah. I mean, just anecdotally, we met a group that buys rental properties. They are not based here in Houston. They are a national group, and they picked Houston as their first market to go to. So people are coming here. It is a great, if you're an investor in Houston, you are in a great spot right now. Like I said, they had 50 markets to choose from, and they chose Houston. Total dollar volume for 2020 rose 18% to a record-setting $35 billion of real estate sold. Think about that. So the units went up 10%, but the volume was up 18. So not only are more transactions happening, the prices are going up significantly. December single-family home sales jumped 25% year over year. That's a big number. Total December property sales increased 27%. The total dollar volume for December, oh, I struggle to say that. The total dollar volume for December was up 39% to 3.9 billion. That is insane. 273 was a single family home median price. That's up 9%. That is a new record high. And the single family home average price climbed 11% to also an all-time high of 347. So we're almost at 350 for Houston for the average price. Single family homes, the month of inventory went down to a record low of 1.9. So again, for those of you that have not been on the last couple of calls of ours, 6 months represents a market that is considered in balance. And what that number means is if no new homes were to be listed for sale, every house would be sold in 1.9 months. So in less than 60 days, all the houses would be gone. Townhome and condo sales rose 11% year over year. Leases of single family homes were down 14.5%, but the average rent went up almost 8% to roughly $1,900. So there are fewer transactions. My guess is that this is because people just, they don't want to move, right? But the rental market is increasing because, like I said, people are coming here. So it's all the way up to $1,900 a month. And then lastly, townhomes and condos were up 13%. The rent up actually almost 4%. Next slide, please.
Yeah, so this is an interesting slide, and there is a reduced amount of transactions happening from 0 to 100,000 and 100,000 to 50. A couple different reasons on that. I think it's hard to find a home in that price point, so people who are there that cannot afford to bump up, I think, are very reluctant to sell. But secondly, there aren't as many homes at that price point because homes have appreciated so much. The numbers just continue to go up and up. I don't know which home in a reasonable condition is going to sell on MLS for below 100,000, but that I would guess it is probably a 2-bedroom, 1-bath in a less desirable area that is not in great condition because the prices just continue to really ratchet up.
I think the key on that statement was not in great condition. Like, I don't know if any rehabbed houses are selling for under $100,000.
It's true. What is really interesting is where the biggest jumps are taking place are in those luxury markets. And, we've mentioned this a couple times. I think me and many others misread how the flip market was going to do during this time, but it has really done well, even in the higher price points. Like, they are selling far more quickly than they did in the past as a $300,000 or $400,000 home, admittedly, but that luxury market has done quite well. And there's flippers who have done extremely well in those higher price pointed areas.
Yeah, I think a lot contributes to that. One thing is just low interest rates. If you think about it, like with the rates as low as they are, you can just afford to buy more house. So that is definitely, and people coming from other parts of the country, most of them that are coming from places that are more expensive than ours. So yes, they're used to these numbers, right? A $500,000 house, somebody in California is no big deal. Here, that's, it's a much nicer place. So this is just kind of a graphic showing the data we talked about last time. Like I said, total property sales up 27%. The volume, a lot of happy realtors out there at 3.8 billion, up almost 40%. Total active listings. So this is the other thing that's always very interesting. I always keep an eye on this. Total active listings are down, right, relative to December. But if you want to skip down to the bottom number, total pending sales, there's 2,100 more houses pending with almost 10,000 fewer listings. So if you do that as a percentage, it's basically double. So I think it's 7% on the left and 14% on the right. So if you have a house for sale, it's twice as likely to be under contract now than it was a year ago. Single family home sales up 25%. Like we said, the average price is $347. The median price is up to 273, inventory down to 1.9. Next slide, please. Yes, sir.
Real quick, looking at the long-term trend we've seen here on inventory, that number is pretty shocking. Like it's almost never below 2, but this is still continuing to trend downward from what I recall. The last few months, I think we're a shade above 2, and then we are down below 2. So very exciting number there. This is the.
I've noticed on the HAR report I think they stopped talking about the impending doom in volume. Like for a while there with the low listings, everyone the commentary was always, it's about to slow down, it's about to slow down. I think they've given up on that.
Yeah. All that's happened is that there's less inventory, higher prices, and lower days on market. There's the velocity at which properties are sold is just increased. This next slide shows the trend, from 2015 to now. It's just there's up and downs, and what you see there with the ups and downs is seasonality, and that's a little bit about what we're going through. Now, though, in certain categories we've seen it, in other categories here with average and median home prices, it still seems like it's really still going up significantly. But I guess that the one little dip is that median price. It looks appears to have flattened out a little bit more than that average number, but still a steady growth trend whenever you take out the seasonality, which is always going to be the big months always happen in the summer and slower months happen in the winter.
Yeah, so these price, and correct me if I can't see the bottom of this slide from my view, but it looks like those price dips happen in December, if I'm not mistaken. So we just had a December, and I don't believe there was a price dip. So that chart, that little consistent graph we see, that is broken this month, I believe. The other thing I thought was pretty interesting, I looked at it. So if you were to buy a house, if you look at the beginning of this chart, if you were to bought a house, the average price, it looks like it's to be what, 275-ish, and now it's up to 347. So that's like an increase of 5 to 6%. However, if you look at just this year, it's 11%. So Houston, over the past 5 years, it's been nice and steady, 5-6% appreciation. This year, it went through the roof. It literally doubled to 11%. So this is single family home sales. Again, just kind of what we were talking about. It's pretty interesting. I mean, they are almost identical. It's just year over year. But then, like I said, look at this month and this chart. It is not identical, and it's just overall it's been raising, right? Every year it's just a little bit higher on the scale. But this chart will look a little different than it did in the past.
Which we can, based on the other information you provided, this shows from 2015 to 2020, and it really is showing that one-way U-Haul, it just keeps going up.
Mm-hmm.
San Antonio.
Let's see here. Yes, San Antonio, sorry. San Antonio continues to really progress, and I think, there's a lot of technology companies that have moved into the greater Austin area, and I think it's kind of spilling over into San Antonio. I have to assume that because San Antonio is definitely not number one in appreciation and the overall speed of the market, but it's definitely a close second to Austin, and at a significantly more reasonable price in comparison to Austin. But you look at the total sales, up 27%. It's a big number. Average price up 19%.
Yeah.
Here, that's a really big jump. Median price up 13. Price per square foot up 13%. Days on market an 18% drop, and the active listings, that's just the total numbers. I don't really know how that has changed necessarily, but the rentals have not gone up as much. If you see, the average price on rentals have increased only by 6%. So the rental market has not grown as quickly as the resale market. And I think there's a couple different reasons about that. We'll show some statistics in a bit. It's just the volume on rentals hasn't increased as much as the volume on sales. And I think, you know, the upside of changing a rental, probably not as big of a deal. You're thinking I may just be there for a year or two. Why am I going to go through all the challenges that you have if it's not like an actual sale that is more permanent, long-term, and then maybe the possibility make big numbers on sell the property because property prices are so high right now.
Yeah, I think that's the main difference. I think that's why you're seeing, because the economic conditions are the same no matter what, but I think there's a massive financial incentive, you know, even if people are a little nervous about having folks in their home, there's a massive financial incentive to sell a house because you can make a lot of money potentially, right? But if you're a renter, there's not a huge incentive to move. There's no incentive. It's a pain, you know. So I think that's probably why you're seeing less activity from renters, and they're just staying put.
Agreed.
I do want to point out before we move on to the next slide. The next slide is still San Antonio, but San Antonio, this is not December data. This is their most updated information that they put out, but they are just a month behind, and I don't think we touched on that. So just wanted to go over that.
Thanks, Dustin.
So this is the annual data. So this is the entire year. So if you look at the sales, there's 10% more sales this year than last. The average price is up 8%. Again, very solid numbers. Median price is only is up 7. So it's not that different between the average and the median. Days on market, 59 days on market on the average. Your price per square foot went up 7%. As far as rentals go, you look down there, there are just a few more rentals, just 2%. So the number of transactions did not go up. The price didn't go up that much either, a little bit, you know, maybe what, 35, 40 bucks a month. But still a very good, we talk to people all the time that are looking for San Antonio deals. Like that is I think Houston is a really good market for rentals, and I think San Antonio is right there with them. I would not be surprised if that kind of becomes a hot market for rental properties. Because if you look at the price overall relative to the rest of the country, even with these increases, it's still very affordable.
Jeff, you broke up on that last bit.
It wasn't that eloquent or anything. Don't worry about it.
Okay. All right, North Texas.
So North Texas, Dallas is definitely increasing, but not increasing as quickly as what we've seen in San Antonio and in Austin. But the median price up 8.9% compared year over year. 12 days less than December of 2019 for total days on market, which is a nice reduction. Closed sales up 22%, active listings down 38%. And as you can see, that leads to that months of inventory, which is a very strong 1.7, even a little bit better than Houston, in line with some of the other markets like San Antonio. But the price appreciation there has not been quite as much. It is kind of in fourth place in the major metros in Texas for price appreciation.
And Austin.
Austin.
Keeping it weird.
So, yeah, Austin is really good market for flips right now. I mean, it was even better 6 months ago, but Austin is a great flip market. They are seeing ridiculous price appreciation. You look at the median sales price up 19% to $365. That's median, not average. If you remember, the other markets, the median prices were below 3 for Houston and San Antonio. I think Houston was about 270, I think, something like that, or maybe even not that high, but it is significantly more expensive in Austin. Closed units, almost 3,400 units, so up 23%. Average days on market is down, it looks like to 29 days, if I'm reading that correctly. Or is it 33 days and it's down 29 days? That would seem like a huge change. New listings up 5%. Active listings down 55%. But pending sales, like there we go. Like I said, you put a property for sale, it's going to sell. Pending sales are up 23%. So despite the number of willing sellers, the ones that do sell are going to sell fast. Total dollar volume, 1.57 billion. That is up 50% almost. And then the months of inventory, they are below 1, which is not a lot of inventory. So all of the things we've been talking about for Houston and San Antonio, they are just amplify them for Austin, and that's what you get. Now, it's not the greatest rental market. I will say that. You have a lot harder time finding cash flowing properties, single families, because of these prices. But if you're looking to do flips, this is a great place.
To add to that, single family is tough, but they do have a tremendous duplex and triplex, quadplex market there, and there is cash flow in those properties. And for those of you that do not know, you can get a conventional refinance for single family 1, 2, 4 properties. So that is a very good way to take advantage of the best terms that are available on properties that have more opportunity to do some unique things because of having 4 doors in one spot. On a side note, the appraisals and some other things are more expensive and often more time consuming. So do keep that in mind. You don't just pay the same amount of money for a single family appraisal as you do a 4-unit, but the economies of scale are there, and you get to have even more properties underneath that super low interest rate that you can get on a conventional loan.
So Wade, does for those guys that have a lot of properties, if you were to buy, say, a triplex, does that count as 1 or 3 for your loan limit?
It's 1 mortgage, so that is it is 1 mortgage. So you can actually, if you do the math on it, each individual that has a 720 FICO score can add 10 mortgages on their name. If you have a significant other, then you could add another 10 under their name, or if you both are on the primary, it might be 19 total between the 2 of you, but you can multiply that number to 4x whatever your max is. If your max is 10 because you have a 720, you could get technically 40 doors and 10 mortgages. Yes.
Yeah, there are some investors that when they start brushing up against that max, they want to really maximize their cash flow, and they go into like triplexes and fourplexes because it's still 1 loan, and it's big, but you can get a lot more cash flow.
Sure. Next slide.
Before we go to the next slide, I am going to ask one of our questions because it pertains to the next slide.
Sure.
What do we know about the updated eviction moratorium? Oh, Jiminy Crickets, we're going into Texas. I'm sorry. I got my slides mixed up. We will be covering that on the last slide. My apologies.
Yes, no worries. We will definitely cover that on a slide. It's a great question and very timely. But on this particular topic, Texas A&M always puts out some excellent information on the real estate market. And this information is from December, so very, very timely. Month over month, home sales across Texas were relatively flat, even down a little bit. But that modest decline was concentrated mostly in areas that were below 300,000. The overall trend was a steep trajectory up. If you look at cumulative sales this year compared to last year, the 11-month sum is up 9%. The rest of the nation is only up 6.4, so it's actually ahead of the rest of the country, but did have that seasonality factor that we did not see in Houston and some of the other markets. Across the entire state of Texas, that seasonality did come into play in December based on November sales. The Texas median home price accelerated 12.7% year over year to a record high of 274.8. That is, I wish we had the trend, but I am very confident historically that's one of the bigger numbers you've ever seen for Texas as a state. And like Jeff mentioned earlier, Texas usually has a more steady appreciation and does not drop hardly ever, whereas some of these areas on the coast where the homes are more expensive in general, there's more ups and downs. But this is a much bigger increase than I recall in previous years at 12.7. Next slide. Oh, I think we may have gone 2. Yeah, there we go.
So that's the one you were talking about.
Next one.
Okay, so let's go to the next one.
Bingo.
There we go. There we go. So months of inventory fell to an all-time low of 2 months. This is over the entire state. So like we said, 6 months is considered a balanced market. Inventory for homes priced less than 300,000 was more constrained, down to just 1.5 months. So if it is below 300,000, it is flying off the shelves. And if you look at the luxury homes, I guess anything $500,000 and beyond, even though it's 4.8, if you look at where it was just a year ago, that is a huge difference. 3 months. You know, if you think I'm going to flip a high-end home, if I have to hold on to it for 8 months just to sell it, that's quite a lot, right? So when that goes down to 4.8, that is a much more aggressive number and more encouraging for flippers. Double-digit annual price growth in the state's metro areas pushed median prices to all-time highs. Austin's was up almost 20% year over year to 371, while the median jumped 13% in San Antonio to 260. Houston, like we said, is 273. That's near the state average, up 11.5%. And North Texas, 11.9% up as well to 328 for Dallas and 278 for Fort Worth. Next slide, please. Thank you.
Yeah, this is a report we often show, and I think the most interesting thing is just looking at the trend. You know, existing home prices, price per square foot, $75 back in 2011, up to looking like 130 in a short 10-year period. So that's a massive increase in that particular category. But I think maybe the most interesting thing is how the gap between new home prices and existing home prices on price per square foot is really shrinking. So what that means is if you own properties, like you buy a property and you hold it as a rental. In the past, those new homes would always be outpacing the existing homes. But because of less inventory and higher construction costs, that gap is really narrowing. And you can see on the tail end of this graph here in 2020, the blue line, the existing home median price per square foot, really jumping. And then the new home price not increasing nearly as much. So that gap is getting really narrow. I would be very surprised if it ever got equal, but that gap is very good for long-term real estate investors. Really good.
Yeah, it just kind of hits on the two topics we've been talking about, where builders aren't building fast enough, and there are too many people want to buy homes, not enough sellers, so they're willing to pay up for an existing house. They don't want to wait for a new home. So Texas homes days on market. This is the difference between existing home days on market and new home days on market, right? So, you know, if you look at this chart, when it started, 2011, you can see we were up in the high 80s and low 100, maybe low 110s, I guess. And we are all the way down to 75 for new homes and less than 45 for existing homes. So it's just kind of what we keep talking about, how properties are getting less and less, they're not lasting very long, right? They're flying off the shelves.
Next slide. All right, so these are construction permits across the country. And while they were not always perfectly aligned, they seem to move relatively in unison for a certain period. You know, it started off at even, that was the benchmark, 100. And then you can see Texas started to grow throughout the 2000s. And then there's kind of a steady stream down whenever the financial crisis happened back in 06, 07. And then the gap started to widen a little bit coming out of that recession. And then recently, look at the numbers here. And this correlates with the U-Haul data and all the other data we've seen about people moving from other parts of the country to Texas, where the new permits in Texas just jump exponentially. And then to a near all-time high, tying back in 06. And then you can see that the all-time high for the rest of the country was above 140, and the rest of the country still hasn't topped 100 yet. Right?
Yeah.
So it's a really big gap.
I think that's very interesting that they based on 2000 as a benchmark, the country hasn't even got back to par yet, and we are up 80%.
No.
Major metro single-family housing construction permits. So this is kind of what we were talking about, just on a Texas level. So if you look at 2000, the stats in 2000 for each city was considered par or 100. It's interesting. Austin had a rough little go there for a minute in the early 2000s. Like they were last place by a mile. Not anymore. They have gone into first place by quite a bit. It's actually, the gap has widened quite a bit, to be honest. But it is nice. Houston's second. They've been in second between Houston and Austin. They've been first and second basically for the past 10 years. San Antonio actually gone ahead of Dallas as well. So it just kind of reiterates what we've been talking about with the markets. Next slide.
This next slide is also very telling. The people who are in new construction, whether that be apartments or single family or duplexes, whatever the case may be, usually really smart people. They have economists who are looking at what is going to happen in the future, and we can often tell where things are trending based on their decisions. So whenever you look at the construction permits, the numbers on 2 to 4 family units are kind of very close with single family at the moment, but both of those look to be at all-time highs and rapidly increasing. And then you look at 5 units, was at an all-time high for a moment there, and then it has really fallen off a cliff recently, which correlates with some of the trends that we've seen, people moving out of cities, wanting a little bit more space. Not a little bit, often a lot more space, because there may be one or more people working from home. Sometimes people feel that they need to feel pressure or even are required to educate their kids at home, which necessitates more space. So they want to have their own amenities, backyard, pool, etc. So this makes a lot of sense with what has happened with coronavirus and the trends on what people are desiring from their living situation.
Total housing sales, again, just kind of showing how Texas has been outpacing the nation for quite some time. There was a little bit where we were running behind, but we caught up and we have widened that gap, kind of like we had a couple charts ago, for quite some time now. I'm sorry, not Houston, but just Texas in general. The real estate market is the rest of the country is catching up to what a good buy it is here.
Yeah, so just using that 100 as a baseline, in 20 years, the total housing sales across the country have increased. That's 22%. Does that look right?
200, 120% for the country. Yes.
Yeah, I'm talking, so the country is about 22%. Conversely, Texas appears to be up 238%.
Yeah.
That is a profound chart. All right.
So months of inventory. Again, so this is not a baseline chart. This is like reality where it was at. So in 7, which was kind of like the beginning of the end, I guess, for the housing crisis. Inventory in the United States was around 7. It went all the way up to 10 when things were bad. Now, ever since 11, it's been kind of dropping steadily. Same thing with Texas. Texas kind of followed the rest of the country, but look at the very tail end there. We are starting to separate ourselves. Just kind of showing once again that relative to the rest of the country, Texas properties are selling a lot faster. Next. Yep.
A couple interesting things here. One to point out, San Antonio has surpassed Houston Houston for a while there was above it. Same thing for Fort Worth, Arlington. So Houston is in last place now, which from a buy and hold perspective, I personally, as an investor, for many people investing in Houston, I think that's not a bad thing at all. But whenever you think about investing in single family real estate, all of these markets, even Austin, is more reasonable than many places in the country. But these other three markets, especially San Antonio and Houston, are great buy and hold markets. And even Fort Worth is not too far off, and I think that's a great area as well. It looks like Dallas, a little bit more problematic because of the pricing, but then Austin is just, unless we're doing the 2 to 4 units, it's very difficult to do anything in the buy and hold space.
Yeah.
Next slide.
Texas months of inventory by price cohort bracket. So, this is the blue line is the lowest, and then it moves on up to the purple line, which is the highest. Man, to sell a $500,000 property in 2011 would have been a challenge. Like I said, if you look at that, the interesting thing is if you look at that purple line, how it has really started to narrow at the end of this chart. The cheapest houses typically go the fastest, right? And I'm pretty sure if you just look at that chart, it kind of lines up from lowest price to highest price. Just kind of reiterating what we've been talking about. The lower the price, the faster it sells.
Next slide, please. Okay, 30-year interest rates. We've shown this chart, a more elongated chart in the past. I think it was somewhere in the 80s. Interest rates were like 18%. So these are still amazing. But whenever you just look at this chart and you see 2007 and like some of the highs were in the 7% range for mortgages, it's not as impressive as whenever you think about what they were not too long ago. But these average rates are still not only historically low compared to all time, but even in the very low interest rate environment for 2007 on, still the lowest we've ever had. I know we got to pick up the pace just a bit.
Yep, we're almost done. So this is the one I think you were talking about. So I believe, I can't see the bottom again, I don't know why, but I believe those numbers that were in the 18s.
Yeah, for the bottom of it, it starts in 1971, Jeff.
Yeah, so I think that's probably like the early 80s is my guess, those numbers. But anyways, if you look at it, what's most relevant to us is the one we're at right now, which is the lowest possible number. So we just kind of reiterates it's a good thing. It's easier to cash flow with low interest rates. It's easier to afford more house with low interest rates. It won't always be this way. So my advice is get it while you can, basically.
So this is where I'll ask the question again. Earlier we had a gentleman ask, what do we know about the updated eviction moratorium? So here is some information that we're going to go over. And I'm not sure who was going to cover this. I apologize. Was it you, Wade?
Yeah, it's not really an updated eviction moratorium. It's just an extension, from what I understand, of what was in place. The word sounds more, I don't know that it accurately describes the situation, because it's not an inability to evict people. It is heightened standards and, a makes sense effort to help out people that are trying to do everything right and still attempting to make some form of payment. It's only really for non-payment. If people are not treating the property properly, or they have, type of problematic dog breed, or they have been, in trouble with the law, anything like that, this does not affect those type of situations whatsoever. What it does affect is if someone is not making payments. They have high standards for what they need to do, and the burden of proof is really more on the tenant to prove that they have done all the things, outreach for assistance, they make less than a certain amount of money, they have to provide documentation. If they have excessive medical bills, they have to provide documentation. So they do need to be able to present this in an organized fashion in order to be able to avoid being evicted if they're not making any payment at all. So Anecdotally, from when I talk with people, and both the statistics that you see, the delinquency rates are not as high as one would think with what's going on. It hasn't been as high as a lot of people would think. But then if you do have a situation, both personally and then other people that I know, and then the statistics say that it is still possible to evict people if they are not going through the necessary steps to avoid that.
Yeah. One of the things, just a topic on that, one of the things I thought was interesting, if you are a landlord, even if they are able to avoid eviction because they qualify, the meter is still running. So at the end of it, you know, if and when the moratorium is lifted, then they owe the entire rent. So unless they've been putting that aside, it's going to be the same situation, which is highly unlikely.
Yes. That is a solution that I think, in my opinion, needs to be figured out. You know?
Yeah.
Awesome, thanks guys. And thank you everybody that joined us for our market update today. We are going to take this time to answer any questions. We do have a few that have already been asked, so I'll be going in order. But if you have a question that hasn't been answered yet in this webinar, feel free to write it into our question box. It should be on the right or left-hand side of the screen. And again, everyone will receive a recorded copy of this webinar. It'll be sent to your email, I think tomorrow at the latest. I think it sends the same time at noon. So it should send tomorrow at noon for you guys. And if you have any questions specifically about a property that you're interested in working on or a deal that you're currently involved in, make sure to reach out to us. You can reach us from the info@catalystfdg, which is on the screen here, or you can call us at our sales number or our support line, and we'll happily get you in touch with one of our fully licensed loan officers, and they're going to be able to talk you through that deal and answer any questions you have that are specific to a deal. Or if you're just interested to see what the process would be like when you find one, call us anyway. We'd love to talk. So we'll go ahead and go in order of the questions. So the first one we have, this one, we're starting out tough. This isn't a softball question. This one's from Jeremy. How will the election results affect interest rates? So good question.
So in my opinion, I do not see it increasing interest rates in the short run. I think this administration is going to want to support the housing market and allow people to have the lowest possible prices on homes. I don't think they're going to want any negative publicity from changing that. So I would anticipate interest rates staying on a relatively steady track with maybe slight increases. As far as policy, I do not see them invoking a policy that would cause interest rates to increase. But sometimes that is not entirely in their control. There are other factors, market factors, that also have an impact on interest rates.
Yeah, I read some guidance from some smart guy that basically said that they would probably go up a little bit over the next 12 months. Was his prediction.
Smart guy, solid source there, Jeff. Solid source.
He was definitely a smart guy.
Okay. Another hard hitter here. This one is going to be from Troy. Troy, thanks so much for joining us again. Troy joins every webinar and always asks questions. We love that you participate and really appreciate it. So this question is for you, Wade. Wade, do you think the overall decrease in state and local tax revenue collections will have significant impact on property taxes in the next few years? If so, what kind of percentage increases are you planning or are you using to forecast and plan?
So on an interesting note, the state of Texas has not had as big of a drop in revenues as much of the rest of the country. I mean, it's been more open. You know, a lot of businesses have been able to stay open, so those drops have not been as significant. In fact, I actually saw a statistic recently that said the state of Texas, the overall receipts, I think for the last quarter were actually greater than before the pandemic, which is kind of surprising. But now I read a lot of information. I do not want to quote that. That's not something I saw here. I'm pretty confident that that information was accurate. I think it also had something to do with a sales tax, how they handle sales tax, some revision to that. But at the end of the day, I do not see Texas being in the situation that many other states are at this moment. Now, I will say there's been a steady increase to taxes despite that. Like my property taxes on the rental portfolio that I own, it is definitely not slowing down, but it does make sense because property prices are actually increasing, right? We see 11% is 11%. State wants to get their money. and they're probably going to bump it up by something close to that 11% this upcoming year. I don't see a shift to the percentages at this point. Like I don't see, on average, probably 2.5%, depending on all the different taxes you have, maybe more if they're mud taxes or other things like that. But in my opinion, because Texas has weathered this storm better than many states, I don't see a change in the percentage.
Awesome. Thank you, Wade. Troy, I hope that answered your question. Feel free to let me know in the comment section as well. Hiren, I apologize that I didn't answer your question. I actually don't know, but these two experts will be able to help you out. So Hiren wanted to know if we had any data on the College Station market and what are your thoughts on doing a buy and hold in the College Station market? Jeff or Wade?
I do not have any stats there.
No.
I don't think.
I think we've done a couple of, I think we've done at least one, maybe two College Station deals. I just know anecdotally, college towns in general rent pretty well. You know, I think you can get, especially if you get them close to campus, you can rent by the room. You know, you may have a little more turnover budget because it's near college campus. You may have to really build in some strong cash flow to pay for potential damages. But no, I mean, just anecdotally, like Wade said, I don't have any stats, but anecdotally, college towns typically do very, very well for rentals.
Jeff, I think you just got back one of your kids from the College Station area, right?
No, God, no. Come on now. No.
Oh, where'd they come back from? Sorry.
San Marcos, Texas State.
Okay. My
Put
bad.
that out there. Don't put that out there, Destiny.
Sorry.
Offense,
That's a good thing. That's a good thing. So this next question is from Lewis. Lewis, thanks for joining us today. Do you see this market as a bubble with the current real estate prices? Great question.
It is a great question, and actually, there's a lot of reasons that I do not think it is a bubble. Do I think home price appreciation is going to slow down? Yes. I think there are several fundamental differences between what is taking place right now and what took place in 07. Number one, credit quality for borrowers is significantly better than it was at that time frame. There were a lot of alternative products that allowed people to buy homes that did not really qualify. There are a tremendous amount of no-doc programs, and there are a lot of very, very high LTV programs that allowed people to purchase homes with no money out of pocket or refinance products up to 125% of the value of homes. So there were a lot of different products and things going on in the market at that time that really led to a lot of the problems. If you look at the overall credit quality today, FICO scores are higher. There are still much more rigid income requirements. Do I think there are going to be some foreclosures because of this? I do, definitely. But there's so much demand for property. I think that will be, taken up by the excessive demand. And I do not see nearly as big of a problem this go around because I do think people in general are more credit worthy, and that makes a huge difference overall.
I saw another article from a smart guy, and his basically what the theory was is that the values have gone up significantly. So even the folks that are facing foreclosure, they have equity in their home. They're going to be, and there's that pent up demand for homes. So those two things could save a lot of people from foreclosures. Now, I guess if it became overwhelming, it could throw it out of whack, but I don't think that's going to happen.
Awesome. Thanks, guys. This next question is from Vitality. That is such a neat name. I really like that. Your question is, hi, do you see more requirements in terms of conventional lending due to COVID? Gentlemen?
I don't know if we lost Jeff there, but
I think we lost Jeff, yeah.
I will say that early on, there were some significant changes from Fannie Freddie, and then even more overlays at lenders. We never had very aggressive overlays in our operations, but there were some competitors who did. That has slowed down quite a bit. I'd say the biggest difference now today than prior to COVID is that there are a lot more documentation expectations, little small things, not necessarily changes significantly to qualifications, but some extra documents. And especially with verifications of employment, there are far more late game verifications of employment. Fannie Freddie, they really want to make sure that the person is still employed at the moment at which they close that transaction. In the past, you could do a verification of employment much earlier in the process. There's still an early verification, but there has to be a very late verification of employment to make sure the person has not lost their job because of the amount of layoffs that have been out there. And by the way, those layoff numbers have dropped significantly since the beginning of the pandemic. They were really, really big early on, and then they have been trending downward since that time.
Awesome, thanks, Wade. Our next question is from Steve, and we are a little over the time. We have 3 more questions left, so if anybody asks a question after that, we may not be able to get to it on this webinar, and we apologize. Please feel free to send us an email, and we can touch base with you then. This next question is from Steve. What is your opinion on tertiary markets such as Livingston and Huntsville for single-family rentals?
Jeff, do you want to take that one?
I mean, we don't see, I personally don't see a lot of it. Like, we don't lend in most of those markets. We will go outside a little bit, but basically not too far to where the overriding major metro is gonna be the answer to the values and the rentals. So like, it's not gonna be out in the middle of nowhere where that is a separate market. We just don't lend in those places. So I really don't have much experience on those.
So I think one thing's important to differentiate. We lend everywhere for permanent financing. So that Jeff is talking mostly about our normal integrated hard money products. We also have hard money products on a brokered basis that we could do anywhere as well, but they will not close in our, really short time, such as 7 days and things like that. But so as far as our core products, we do not operate there very often. I will say we don't know about that area very much, but I do know some people who've been very successful in markets like the Golden Triangle. There's a lot of new construction and refineries and things of that sort where there are a lot of people who want reasonably priced rental properties. So I think there are some tertiary markets who've done very well. I have no idea about those 2 particular markets.
The other thing that we've come across is you want to make, the fundamentals don't really change, right? So make sure you're buying deals that I would expect maybe on smaller towns, more of a discount. I'm guessing there'd be less competition, less certainty. So I would want to get a discount if you're looking at deals. You need to find a way to pull comps. Like sometimes, depending on where it's at, it's really hard to find comps. So make sure you have that nailed down, either you or your agent or whoever you're working with. Make sure you have the ability to pull accurate comps. But other than that, the fundamentals don't change. I would just expect a discount relative to what you would pay in, say, in Houston.
Sure, completely agreed.
You're on mute, Destiny.
That's not very helpful to anyone, I'm sorry. Thank you guys for answering that last question. This one is from Scott. Given the current competitive market conditions, what revisions, if any, are you seeing to the MAO formula of a 70% ARV cost for repairs? Thank you.
MAO?
MAO.
If the person that asked that question is still around, please type what MAO stands for.
Scott, feel free to write in, and we can actually skip to the next question if you guys want. We can come back to this one. I
think I know what they're talking about in general. It says like, I think they're saying that they need to buy at 75% of after repairs value.
70.
They said 70. I would say there are no deals out there from wholesalers or that have any reasonable marketing capabilities that are sold at 70%.
Yes, Destiny?
We got clarification, maximum allowable offer.
Okay, so yeah, so basically not paying 70%.
Yeah, those numbers are from days long gone. If you're going to be buying in any competitive situation, 70%, I haven't seen many people like you. If you market yourself, you may be able to get a deal at 70%.
Yeah,
for sure. But if you were buying from wholesalers, there's no reason for them to sell to you at 70% whenever they could sell a flip probably from 75 to 77.5, and then a buy and hold 85 to 90 is what we're seeing. 85 to 90% on a buy and hold type transaction. So, and the thing is, those numbers, while they're not as attractive as they were in the past, relative to other investment opportunities and even real estate investment opportunities in other parts of the country, they're still amazing. Like those are amazing numbers compared to other investment classes or real estate investments in other parts of the country. And that's why that's why this hedge fund out of California is focused on Houston entirely, because it's such a great market compared to everything else, even though the numbers are not what they were, even 3-4 years ago.
Yeah, the only time I see deals at 70% and when we get lucky and you get a great appraisal. That's it. But they're never sold at 70%.
Unless you're buying directly from the seller. That's the only thing.
Yes. If you're getting in the house, if you're getting in somebody's living room and buying that house, by all means, you can do 70%. But if you're buying from a wholesaler or MLS, no chance.
Well, and what a great segue, Scott. We happen to be doing a wholesale webinar next week going over the 7 steps to success in wholesaling. So if you want to join us for that one, we can help you score that 70% ARV deal. Not to plug too hard, but we do have an upcoming webinar, and I'll be sure to send everyone the link if anyone's interested in joining us for that as well.
I do have to wrap up. I've got time for one more, Destiny. That's it.
This is our last question. Okay. So this one is it better to wait for prices to stabilize and come down? Basically, it's saying, i.e., invest into the next quarter since prices are so high now. So they're asking, should they wait, should they stay, or should they go?
So that's an interesting question, and that's the same question that everybody's been asking since about 2008. I need to wait until the prices drop, and they just have not for 12 years now. I don't see that happening anytime soon at a level to which it makes sense. I think trying to wait on the market to drop is going to be complicated because there's so many indicators right now that stretch allow significant price drops. I just don't see it yet.
Yeah, if you're buying, if you're doing for buy and hold especially, just buy in intervals, right? If you want to add 10 properties, space it out a little bit. If you're freaked out that you're going to buy everything at the top of the market, it's highly unlikely, like you said. Also, if you just look at the national numbers, our costs relative to the rest of the country, we are not anywhere near the top. We're in the bottom of price per square foot. We're still at the bottom of Texas. Like we are the lowest of Texas still right now. So even though it feels high and they've been going up a lot, there's still a lot of room to go.
Yeah, I feel relatively confident that if there is a foreclosure crisis of any size, that's probably going to be concentrated in some other parts of the country, very likely. And then if that the demand, especially here, would be sopped up relatively quickly. Those are the two things that I really think. And you have to have two things happen. You have to have a lot of inventory for foreclosures and nobody being willing to buy them to see significant price drops. That's what happened in 07 and 08, but it didn't really happen here in Houston. It did not happen in most of Texas. The prices just did not drop that much because we haven't had those big ups and downs. Now we have had more of a steady up, but still comparatively to the rest of the country, the affordability index here is very strong. If you don't know that stat, you could look it up, but the affordability index basically means incomes in a given market relative to home prices. And Texas is arguably the best in the country, even in the major metros, and Houston is one of the best as well. Okay, Destiny may close it up, but I think we are wrapped up. Really appreciate everybody's time. I think this is going to be a very good year for real estate investors. If you want to talk with anybody on our team, you can reach out to us at 832-648-3626 or go to our website and schedule an appointment or fill out a contact us form. You guys have a great day and happy investing out there. Have a good one.
Thanks, everybody.